Now we've got Geoff Dennis joining us. He's head of Global Emerging Market Strategy with UBS. He joins us from the sidelines of the conference. Geoff, thanks very much. Good morning. Good to have you with us here. Thanks for taking out the time. Simple question to you. For dollar investors, markets like India, other emerging markets, have been a poor choice over the last 4 or 5 years, point to point. Is that going to change? Are we at an inflection point, as many believe we are?
I don't think we're at a strong inflection point. I'm hedging my bets here a little bit. We do think that the dollar is probably going to continue to rise somewhat against the major emerging market currencies in 2016, but we are expecting a little bit less of a rally in the dollar next year, so there'll be a bit of relief from this year. We've lost on average 7.5% in EM this year on currency, which has been the worst year for currency in EM since 2008. And of course that includes some currencies that don't move at all, pretty much like the Chinese renminbi, for example. So an average of 7.5%. We think it won't be quite so bad next year. But what really is going to make the markets hit an inflection point or not is going to be the path of corporate earnings growth, because that's really what the key is. So we've lost out on the currency in 4 or 5 years, but things would have been better if we'd had some corporate earnings growth. So we're watching both of those factors for next year.
Can you detail the extent of the underperformance for, say, any EM basket that you look at, vis-a-vis, say, an S&P or a developed market index?
Yeah, without a question. We have a particular model that we run on a quarterly basis with lots of background to it, metrics behind it. But basically, from the end of 2010 until the end of September this year, and obviously October was a better month for EM, but over that 4 3/4 year period, developed markets were up 24% in dollars, which was mainly the US, to be fair, and emerging markets over that period were down 30%. So that is a dramatic and sustained underperformance. And of course, what that means is that most global investors who can invest in both DM and EM have been underweight to emerging markets over that 5-year period. So the underperformance has been stunning. It's for 2 reasons, as I say: weak earnings growth and the strong dollar.
Okay, another slightly larger question. Where does most of the institutional money sit? Does it sit? What kind of funds have the most firepower? Do they sit in global funds, developed market funds, emerging market funds? As you track the universe, where does it sit? Because there's a fair bit of argument here that even if there is no inflection, I'll come to India later, that India gets sold into because EM funds are getting out, India's story is better. I mean, that's the routine argument given by most equity people. But some believe that will change. India will stand out even if EMs continue to get sold. Your view on that later, but just tell us, where does the money sit? Bulk of the money sit. Who's got how much firepower?
The biggest firepower, without any question, is in global funds. There's a lot more global fund money than there is emerging market money. But the problem with that, of course, is that emerging markets are about 9.5% to 10% of the global benchmark now, whereas 5 years ago that was nearly 14%. So how much of that money we actually get into emerging markets is obviously unclear. And of course, more recently, as I implied a few moments ago, investors have had a lot less than 9.5%. But that's where the marginal money could come from if investors turn somewhat more constructive on the emerging market side. In terms of global emerging market funds, we're a much smaller pool of money. We've had also huge outflows from GEM funds this year, amounting to $62 billion, which is by far a record in absolute terms, worse even than 2008. So we're seeing global money, of which there's a lot being underweight EM, and we've seen EM funds, which are much smaller, generally losing assets in 2015. Of course, there's always the hedge funds, and the hedge funds come in and out more rapidly, and they're harder to track in terms of assets, etc. And they can make a big difference in the short term. But the big long-only money has either been away from EM or it's actually been shrinking. For
our viewers, global funds can move in Emerging markets can invest in developed markets, which is the biggest of the lot. Emerging markets is money raised specifically for emerging markets, right? And you've been saying that that's anyway much smaller in size relative to the global funds, and it's been shrinking now for the last couple of years.
Mm-hmm. Correct. That's right, yes.
Okay. All right. And you said in the beginning that you aren't betting on that tide to turn anytime soon. It's going to be all about corporate earnings growth.
Yeah. Now, the way we're looking at corporate earnings growth for next year is we're splitting it up between kind of structural secular factors and more cyclical factors. On a structural basis, it's really hard to see a dramatic improvement in earnings growth next year. Across the asset class overall, there'll be pockets of strength, of course, and pockets of weakness. We think what drives emerging market earnings long term is things like the rate of economic growth in EM, which is still somewhat sluggish, the rate of global trade growth, which is certainly very weak in this particular cycle. Also a number of microeconomic factors like cost control and in certain emerging market companies, overinvestment, overproduction, so margins have gone down. I'm not sure you're going to see a dramatic change in those secular factors. But where we think earnings will get a nice boost next year is because we've taken an enormous hit to earnings this year from, as I said, the strong dollar, but also from the collapse in commodity prices. Now, if you get less dollar strength and less commodity price weakness in 2016, you'll get a cyclical bounce in earnings. And this is one of the reasons why we think markets do better next year, because we think there will be a better earnings story. But it'll be rather a kind of mechanical bounce off a low level rather than necessarily expecting to see some strong secular improvement in the growth story. What we really need for EM to do better from a secular point of view, long-term point of view, is we need better growth. We need better top-line growth, revenue growth for companies, better GDP growth. And that, of course, is relatively elusive, except in a number of countries.
Just come to India now, Geoff. India is what percentage of the global benchmark? And just put that in historical context for us. I mean, what was the peak and where are we now?
I can't recall what the peak is, to be honest, but it's about 8%. It's been going up over time recently because we've seen some outperformance over a number of years. But I suspect it was probably a little bit higher than that earlier this year when obviously India was outperforming significantly. But it's around 8%. It's now the fourth or fifth biggest market. Varies, on a short-term basis. The only markets that are sustainably bigger than India right now are China, Korea, and Taiwan. So it is a very important market. It's much bigger than Brazil. It's much bigger than Russia. So it is a very important market. It's around 8% of the GEM benchmark.
Okay. 8% of the global emerging market benchmark. And you said that EMs as a whole are about 9.5% of the overall benchmark, the global benchmark.
So it's it's just under 1% of the global benchmark. So obviously for a global investor, it is not that important in relative size. But what that means is that if investors at the global level want to make a bet on India, which we think investors should do, we're overweight the Indian equity market, they could put a double weight on there and it wouldn't be that big an exposure because India is, as I say, under 1% of the global benchmark. So I'm sure investors are out there wondering whether this should be the year when emerging markets do a bit better against EM, given that they've done so poorly for 5 years. And to the extent that they put that trade on, India is going to be one I think they look at because it is growing strongly, the economy, and it's such a small part of the benchmark, so you can make a big bet there, and it doesn't really increase your risk dramatically.
Just half an hour back, I was speaking to the chief investment officer of one of the largest local mutual funds here. And he was saying that over the next 12, 18 months, he believes, because of the strong macros and growth that you have in India, better rather, not strong, I guess is the right word, even if you don't see a turn and a tide turning for emerging markets, India should do much, much better. It should stand out on its own. Many others that I speak to regularly, they kind of sort of diss that idea, where they say, well, it's just another market. Where do you stand on this?
Well, it is just another market, but it's also a market that I think truly does stand out. The points that we make about India are clearly the long-term process of structural reform. I am, of course, we're very well aware about the political setbacks the government's received in Delhi earlier in the year and recently in Bihar, which undoubtedly is likely to slow the process of structural reform. But we believe that what investors should be doing, and I think are doing to a certain extent, is judging this government on its full 5-year term, not on the first 18 months. And over time, the structural reform process, we think, will continue to make some sort of progress. But even if you step aside from that for a minute, we've got an economy here that's growing north of 7%. Really for the next 2 financial years, probably between 7.5% and 8%. And given that China is slowing very rapidly now, probably more rapidly than we had anticipated, you are now looking at a growing growth gap between India and China. So although the backdrop to these economies and the makeup of the stock market is very different, you've now got India clearly taking over the leadership of emerging market growth, very progressively quarter by quarter. And I think that will encourage investors to invest in India. Now, certainly translating that into corporate earnings growth has been challenging recently. We've had a number of quarters of softer earnings growth, but we strongly believe that with some reforms, with strong economic growth, with the strong performance, the solid performance of corporates in India, and which should not be forgotten, the tremendously respected policy of the RBI in dealing with inflation expectations and now being able to reduce interest rates possibly quite sharply over the next 12 months or so, that we think amounts to a situation that will be attractive for emerging market investors in a world, frankly, where there isn't a lot of growth in a number of other countries. So that's how we look at India. In other words, don't worry that much, we're saying to foreign investors, about the political setbacks, about the reforms. The reforms will happen gradually, and the growth is there. And that's, at the end of the day, why people want to invest in equity markets. It's really for growth.
Mr. Modi has been, of course, in a way, the Pied Piper, bringing in a lot of interest back into the country. But there's also the RBI Governor, Raghuram Rajan, according to some, the second most important man for financial markets, at least. Would you agree with that? By the way, his term is up in September next year. Would it be a significant disappointment if he weren't to get an extension?
Totally. It would be a big disappointment if Mr. Rajan was replaced or decided to leave. I think that would be a big disappointment because they've done a frankly superb job. From a situation where in the past the RBI has gone through phases where its policy has been good, its policy has been less good, at times there's been political interference in the way the RBI works. This has been a very successful period of time. And as I said earlier, the way that's coming out now is having done all the hard work to control inflation expectations and to bring inflation down, you're now reaping the benefits of that with interest rate cuts, including, of course, a few weeks ago, the 50 basis point cut, which was actually bigger than expected and was followed by a stronger rupee, which means people decided, hey, that's good news for the economy and brought their money in. So it would be a major blow if Mr. Rajan were to leave office, and absolutely he's tremendously important to this whole Indian story without any question, against the background of course, what the government is trying to do on reforms is also, by definition, very, very important indeed.
When you said earlier that, just to go back to the point about India and investing, and you said investors should bet on India, you said even if investors were to double their bet, it wouldn't be that much. It would be pretty small as part of the total benchmark, the overall benchmark. Do you find the problem also is, the size of opportunities here? I mean, the size of the overall opportunity is very large, but, big funds have criteria in terms of market cap, float and things like that. Is that a big hindrance as well when you look at what to buy? Because then everybody buys some of the marquee, well-known companies and, bid-up valuations very, very high. It's happened before. It's happening now. So is that a challenge at all? Or your thoughts, basically?
It's always a challenge in emerging markets, but India is a relatively liquid market now. There are a lot of very good companies. And so I don't see that being any more complicated in India than it is in some of these other larger markets. I mean, China is triple the size of India in terms of its weight within the emerging market benchmark, and yet some people have a lot of issues trying to find stocks to buy in China because of the dominant role of the banks, for example, in China. But when I said double weight, I don't want everyone to get carried away here. What I'm actually saying here, I think if you put a double weight in India in an emerging market fund, you're making a very big bet indeed, because in broad terms, you're putting 16% of your money in against a benchmark of 8. That's a much bigger bet. Whereas for a global fund that's has as their benchmark India at under 1%, a double weight there is much less of a bet. So please don't think that I'm recommending EM investors have a double weight in India. I just think that it makes sense for investors at the emerging market level to be overweight in India. And our understanding is very much, and our view is very much that there are stocks to buy and there's plenty of liquidity. So I think it is a great market to be in. But it is expensive, and what we desperately need, as we need in all markets, but we need it in India too, is we need corporate earnings growth, and that's, to me, the biggest challenge that we face in the emerging markets right now, and that's also true in India.
Geoff, thanks very much. Great speaking with you. Thanks for taking out time for us, and hope to speak with you again soon. Thanks indeed. Geoff Dennis with UBS with that perspective.